Can I predict what's happening to the housing market right now?
The housing market is one of those topics that seems to be on everyone's mind lately. With all the changes happening, it's hard to keep up. I'm here to help you understand what's going on and why it's so volatile right now. Here's the number that should terrify every home buyer in America. 4.1 months. That is the current supply of unsold inventory. It sounds like a boring stat, but it's the highest it's been in years, and yet prices just hit their 33rd consecutive month of year-over-year increases. We are living through a ghost market. Sales are plummeting, down nearly 4% just this past month, but prices are still rising. The rules of supply and demand are breaking in front of our eyes. If you're waiting for a 2008-style crash to save you, you might be waiting for a train that isn't coming. Today, we're pulling back the curtain on the secret forces keeping this market propped up, and why April 2026 is the most confusing time to buy a home in human history.
Welcome back to the channel. I'm JayV, and we are diving deep into the housing volatility of 2026.
For 2 years, we've been told that high interest rates would eventually break the back of home prices. We were told that the lock-in effect would vanish. Well, it's April 2026, and the Federal Reserve just held rates steady again at 3.5% to 3.75%. Inflation is acting like a stubborn tenant that won't move out, and the spring buying season feels more like a standoff. In this video, we're going to break down the 3 major shifts happening this month, from the massive NAR settlement changes that are rewriting how you pay your agent, to the rise of refuge markets in the Midwest. If you have money in real estate or a dream of owning a front door, you cannot afford to miss this. The stagnation paradox. Let's talk about the elephant in the room: affordability. We are currently in what economists call the stagnation paradox. The buyer's struggle. If you're a buyer, your purchasing power has been sliced. Even though mortgage rates have eased slightly from the 8% peaks of 2024, they are hovering in the mid-6% range. For a median-priced home of $408,800, that's a monthly payment that would have bought you a mansion 5 years ago. The seller's trap.
Sellers are in a different kind of prison. About 6% of sellers are pulling their homes off the market because they aren't getting their dream price. They're looking at their 3% mortgage from 2021 and realizing that moving means doubling their interest rate for a smaller house. The result? Inventory is up 20% compared to last year, which should be good news for you.
But it's still 11% below pre-pandemic norms. We have more houses sitting on the market, but they are the wrong houses at the wrong prices. We're seeing bidding wars in places like Hartford, Connecticut, while prices are actually starting to dip in the West. It's not one housing market anymore. It's a civil war between regions. Buyers and sellers are facing some tough decisions. High interest rates are making it harder for people to afford homes, while low inventory is driving up prices. And to make matters more complicated, prices are fluctuating wildly. It's a challenging time for everyone involved. One of the main questions on people's minds is, what's causing all this volatility? Is it just a normal market correction, or is something more going on? Another question is, what does the future hold for the housing market? Will prices continue to rise, or will they start to fall? These are just a few of the questions we'll explore. As we try to make sense of it all, it's clear that understanding the current state of the housing market is crucial for anyone looking to buy, sell, or invest. Explorations, development, the hidden drivers. So what is actually causing this volatility? It's not just high rates. It's a cocktail of 3 specific things happening right now. 1, the inflation lag in the Fed's final move. The Fed is playing chicken with the economy. They projected 1 rate cut for 2026, but the shelter component of inflation is still rising at 3%. Because housing costs represent about a third of the Consumer Price Index, CPI, the Fed can't lower rates until housing cools, but housing won't cool because the high rates are keeping supply low. It's a circular nightmare. 2, the death of the 6% commission. This is huge. The National Association of Realtors, NAR settlement has officially changed the game. As of now, sellers no longer have to bake in a 3% commission for the buyer's agent on the MLS. The good and the bad. First off, let's talk about the good. The good, this could technically lower home prices over time as selling costs drop. The bad, first-time buyers who are already struggling for a down payment might now have to pay their agent out of pocket. This is creating a massive barrier to entry that didn't exist a year ago. 3. The refuge market migration, and investors and families are fleeing the Sunbelt cities like Austin and Phoenix, where prices got too ahead of themselves. They are flooding refuge markets in the Northeast and Midwest. Top markets for 2026, we're seeing double-digit growth in Rochester, New York, and Grand Rapids, Michigan. Why? Because the median price there is $384,000, well below the national average. If you live in these areas, your boring town is suddenly a speculative gold mine. Inflation is one of the key factors impacting the housing market. When inflation rises, interest rates tend to follow, and that's exactly what's been happening lately. The economy is also playing a role, with some experts predicting a recession on the horizon. Recent policy changes have also had an impact. The government has been trying to cool down the market with regulations and interest rate hikes. But are these measures effective, or are they just making things worse? The answers are complex. The relationship between inflation and housing prices is particularly important. When inflation is high, people tend to look for assets that can keep pace with rising prices. Real estate is often seen as a safe bet, which drives up demand and prices. The institutional pivot. You've heard the horror stories about BlackRock buying every house on your block. But the data for 2026 shows a massive shift. Large institutional investors, those owning 1,000 plus homes, have actually been net sellers for 7 consecutive quarters. They are dumping inventory because cap rates, their profit margins, are being squeezed by rising insurance and maintenance costs. The big money is leaving. But don't celebrate yet. The mom and pop investors, those owning 1 in 5 homes, now control 92% of the investor market. Your competition isn't a faceless corporation anymore. It's a guy named Gary from down the street who is using a HELOC to outbid you. Another factor to consider is economic trends. A strong economy with low unemployment can boost the housing market, but a recession can have the opposite effect. The takeaway here is that the current trends in the housing market are complex and multifaceted. For potential buyers, it means being cautious and doing your research. For sellers, it means being realistic about prices and timing. And for investors, it means diversifying your portfolio and being prepared for anything. The 2026 Unlock Moment. Here is the key insight you came for, the 1% rule. Economists are predicting that a single 1% drop in mortgage rates will unlock 5.5 million households who are currently on the sidelines. About 500,000 of them will hit the market the second rates touch 5.9%. If you are a buyer, the moment rates drop, the inventory increase we're seeing now will vanish in a weekend. You are in the eye of the storm. Right now, there's more inventory and less competition than there will be in 6 months. If you are a seller, your leverage is peaking in the Midwest and Northeast, but it's leaking in the West. If you're in California or Washington, the buyer's market has already arrived. The near future isn't a crash, it's a rebalance.
Incomes are finally growing faster than home prices, 3% versus 2%. For the first time since 2020, housing is technically becoming cheaper relative to your paycheck, even if the sticker price stays high. The near future looks uncertain, but one thing is clear: the housing market is not going to be the same as it was just a few years ago.
To wrap it up, the market is in a temporary state of gridlock. High rates and the lock-in effect have created a floor for prices, while the NAR settlement is changing the math for every transaction. We are seeing a massive regional divide. The Midwest is booming, while the West is cooling. It's a weird, volatile, and frustrating time, but the American dream isn't dead. It's just relocated to a different zip code. The housing market is volatile right now due to a combination of high interest rates, low inventory, and fluctuating prices. Inflation, economic trends, and policy changes are all playing a role. Are you seeing more price-reduced signs in your neighborhood, or are you still seeing houses sell in 48 hours?
Drop your city in the comments. I want to see the boots on the ground data. If this deep dive helped you make sense of the chaos, hit that subscribe button.
We do these market updates every single week to keep you ahead of the curve. And if you're a first-timer, you need to watch our next video. Is the American Dream a pyramid scheme? The rise of fractional living. Thanks for watching, and I'll see you in the next one. If you've been affected by the housing market, share your story in the comments below. Don't forget to subscribe for more real estate updates and check out our videos for more insights.